Hi, I'm Nicole Urken, Research Director for Mad Money, and welcome to Behind the Scenes of the show. I'm here with Jim Cramer, and we're talking about breaking up. Now, Jim, when people talk about breaking up, it's not often a happy topic. We get the People magazine celebrity breakups, the personal angst stories, but on Mad Money, breaking up has created a lot of value at a lot of companies.
Well, first let's just say no company wants to be broken up, okay? Because everyone feels that what they have is great.
Right.
But then when it's presented as being something that's worked for other companies, then management has to take a hard look and decide, you know what, maybe we should do that. So in other words, like think about it like in real life.
Yeah.
It's like I've led my life X and it's good. And then suddenly comes along and says, no, you got to do Y.
Right.
But if Y has worked and you believe that you're working for the shareholders, then you got to take a look at it. And that's what we were doing at PerkinElmer. We were saying, take a look that you do have two companies and one is more valuable than the other.
Right, so let's back up. Yesterday we looked at PerkinElmer. This is a detection company in the life sciences tool space.
Right.
It has higher growth, but it's been trading at a discount to its peers. And we said, look, it has this human health division, which has secular drivers, a higher margin, 22%, growing at 5%.
Right.
And then we have the environmental business, which has some areas of strength, but is more volatile and cyclical and has much lower margins at 13%. When we did the valuation, we said if they broke up, you could see a 60% pop.
Well, why not? I mean, the part that is doing great, it looks a lot like Lifetime, which is a tremendous company.
Lifetime Technologies,
Lifetime
which was
Technologies
taken over
got
by
taken-
Thermo Fisher.
Right, and like PerkinElmer is it's a great company, okay?
Yeah.
But they did have a bad quarter. Now,
Right.
you could judge them and say, it's harsh to look at that one quarter. But you still have to understand what Wall Street wants as a CEO. And a lot of people don't want to respond to Wall Street. One of the reasons why we're seeing such increased activism, whether it be Hess, whether it be Tim Hortons, whatever, is that people are looking at these companies and saying, you know what? They shouldn't be under one roof. And I think that the disappointing quarter made that clear that PerkinElmer shouldn't be under one roof. Now, let's say I'm on the board of PerkinElmer, I'm watching this, okay? I think I'd say, you know what? We should at least explore the notion. I mean, like Timken, which is a company that Mad Money's liked, and it's also owned by Action Alerts. There are lots of people who think it should be split up into a higher performing and lesser performing. If it made sense, and an honest board looks at it, maybe it makes sense, maybe it doesn't. Or maybe, and I think the PerkinElmer guys could say, one of them's not standalone, Jim. The environmental service is not standalone. I disagree with that. I think that's a great gem. It's just not hitting now because it's not, I don't think they're getting the resources they should.
So in other words, we're not just judging them based on this one quarter. We looked at the value of the underlying company, but the quarter tells a lot. We're changing from this notion of the company can diversify and you can invest in a company and have exposure to early and middle and late cycle, this traditional conglomerate type of idea like a Tyco was. And we're saying now actually people like investment managers that are diversifying into different businesses, not companies that are diversifying.
Look, it'd be one thing if Marathon went down. It'd be one thing if Kraft Mondelez went down or all the various pharma spinoffs.
Right.
But they've been great.
Right.
So therefore, it is not a embarrassment to relook at the company. I am sure that when Irene Rosenfeld looked at her initial portfolio with Kraft and Cadbury, she didn't say, wow, you know what, this is a mishmash, I should split it up. But in the end, if something gets your shareholders happy, that matters because the shareholders own the company. Right. So the shareholders own PerkinElmer, the management is the steward. I think the management should look at our idea. They can say, listen, let me tell you, we think the stock's going to go to 25 if you do it. But if the stock's going to go to 40 if they do it, well, why not do it? Exactly. And that's what we're saying.
All right, thank you, Jim. All right, PerkinElmer, listen to the Mad Money Investment Bank recommendation. Breaking up might make your stock go higher. These breakup names have been big wins. I'm Nicole Urken with Jim Cramer. Thanks for being with us.